In this video, we're going to talk about exchange rates, both nominal exchange rates and real exchange rates. So the exchange rates that you see, on Yahoo Finance or Bloomberg or wherever are nominal exchange rates, right? They give you the price of one currency in terms of another. Now, one of the things that I find very frustrating is that they're not always consistent about whether it's, foreign currency in terms of a dollar or dollars in terms of a foreign currency. So we will be consistent, right? We're always going to talk about foreign currency in terms of dollars as our exchange rate. So the foreign currency, the pound, the yen, the euro, will be in the numerator. The dollars will be in the denominator. But just keep in mind that when you are looking at exchange rates, right, often for you'll see yen per dollar, but then you'll see dollars per pound, right, rather than the other way around. And I don't know why they do it. And often when they write it, it looks opposite to what they're actually doing. So keep that in mind. Then we also want to think about the real exchange rate. So the nominal exchange rate is how many, units of currency you can exchange. The real exchange rate is, well, what is the price of goods in one market compared to the price of goods in the other market. And so that gets us closer to, a better way to compare different economies. Now, we've already talked about what we think of as the gold standard in terms of comparing different economies, which is purchasing power parity. And we'll talk about that a little bit as well. So just some terminology, first of all. So we said the real exchange rate is the price of domestic goods relative to foreign goods. And we'll use epsilon as our real exchange rate. The nominal exchange rate, which we'll just call E, is the price of currency in terms of foreign currency. So domestic currency in terms of foreign currency. I find that way to explain it a little bit confusing. I always like to think of it as foreign currency divided by home currency, because when we start adding up, for instance, GDP, we're going to need to make sure that everything is in the same currency or in the same goods, and so we'll have to use the nominal exchange rate if we're talking about nominal GDP, or the real exchange rate if we're talking about real GDP. So one example of a nominal exchange rate is yen per dollar, right? So it might be 108 yen per dollar. Then we're going to talk about appreciation and depreciation a lot. So first, let's talk about nominal appreciation. So this would be an increase in the price of the domestic currency in terms of a foreign currency. So that would be an increase in the exchange rate. You get more foreign currency per dollar. And sometimes we call that a stronger dollar. It's great if you're buying imports, if you're going, to a foreign country as a tourist, because you'll be able to buy, you'll be able to get more foreign currency for each dollar. It's not good for exports because it means our exports are more expensive. So we'll talk about that as well. And then a nominal depreciation is just the opposite, right? So a decrease in the exchange rate, a decrease in the price of the domestic currency in terms of the foreign currency. And so, that is good for exports because our exports become cheaper for foreign customers, but it means imports will be more expensive. So if we look at, we'll get there in just a minute. So most exchange rates these days float, meaning that the value of the exchange rate is determined by the market. But we still do have some fixed exchange rates, and we used to live in a world of almost all fixed exchange rates. And the idea behind fixed exchange rates is that it doesn't change from day to day, right? So, it used to be 5 francs per pound, or, $2 per pound. I don't know if that was the actual fixed exchange rate, but it was something like that. But the problem with a fixed exchange rate regime is that if inflation is different in different countries, then there's a big arbitrage opportunity. And as foreign exchange markets sort of developed in the middle of the 20th century, when we had these sort of fixed exchange rates after Bretton Woods, that put a lot of pressure on the system. There was a lot of money to be made. And if you wanted to protect that exchange rate, then it was going to be very expensive for those countries. And so in a fixed exchange rate regime, then you have, either revaluations or devaluations to try to adjust for that differences in inflation and growth. So a revaluation is an increase in the exchange rate, and a devaluation is a decrease in the exchange rate. Most countries have decided that that's not necessarily worth it to them, although there are some major exceptions. And that's why they allow the exchange rate to float. So if we look at the nominal exchange rate between the dollar and the pound, so this is dollars in terms of pounds, right? So, the pound is worth more than $1, so that's why it's less than one. But as I said, if you go online, you'll often get the inverse of the exchange rate. So you'll see it being greater than one because it's dollars per pound instead of pounds per dollar. But you can see it varies quite a lot, right? So this is going back to 1971, where it was about 0.4. So this is just after Bretton Woods has fallen apart, which was the system of fixed exchange rates that came after World War II. You can see that there is a big spike in the early 80s, came down, it's kind of steady, and then it's been bouncing around a fair amount, but it's around 0.65 as of 2015. So it varies a lot, and this is one reason why you don't want to use nominal exchange rates when you're thinking about adjusting GDP or GDP per capita when, say, comparing the United States and the United Kingdom, because, GDP per person didn't change by, more than 2 times between 1980 and 1983. But there was this big exchange rate appreciation from the U.S. point of view. Okay, so let's think about the real exchange rate. Now, so I said we're going to use this little epsilon as our real exchange rate. And so we need to think about how this gets constructed. Now, in this book, whenever we have an asterisk or a star next to a variable, that means it's the foreign variable. So remember to think home and foreign, or, home and away, home and the trading partner. So the price of U.S. goods in dollars is P, right? So that could be the CPI, it could be the GDP deflator. And in order to get the price of U.S. goods in pounds, we multiply by E, right? So E is the exchange rate, that's pounds per dollar. So P is in dollars. We multiply by E, the dollars cross out, we get U.S. goods in terms of pounds, that's EP. And then in order to get it in terms of UK goods, we need the UK price index, right? And so that is P star. And so we're in pounds now. P star is in pounds. So we divide by P star, and now the pounds cross out, and now we're back in goods. And so our epsilon, right? This is just a different version of epsilon here. That's the same thing, though, is EP. So the exchange rate times the domestic price level divided by the foreign price level. And so you can see what I was talking about, right? Because inflation is changes in P and P star. And so the real exchange rate can change either because the nominal exchange rate changes, or because the ratio between P and P star change. And so that's really important because if you have a fixed exchange rate and that ratio changes, that's going to change the value of the real exchange rate, and now you have to worry about defending your currency and crazy things like that. So we can have real appreciation and depreciation the same as nominal appreciation and depreciation, but now we're in terms of goods instead of in terms of currency. So a real appreciation is an increase in the real exchange rate, so epsilon goes up. And so this would be an increase in the relative price of domestic goods in terms of foreign goods. And we can also have a real depreciation, right? A decrease in the real exchange rate, which is a decrease in the relative price of domestic goods in terms of foreign goods. So if we look at the nominal exchange rate and the real exchange rate, you can see this was the problem, right? Where we had this, real exchange rate where it was almost 1, and a nominal exchange rate where it was 0.4. This is why Bretton Woods fell apart, partially. And eventually now they move more or less together. And so that's important. Allowing a floating exchange rate means that your nominal exchange rate and your real exchange rate are going to be much closer. So I think that's important to keep in mind. All right, so from the United States point of view, it's not necessarily one exchange rate that we care about, right? We trade with countries all over the world. Our two, closest geographic trade partners are Canada and Mexico. We also, of course, trade a lot with China and the European Union. And so what we really care about is the sort of multilateral exchange rate, where we take a trade-weighted exchange rate, and that will help us figure out, where our imports and exports, why they're going up or going down, et cetera, and whether or not we have, whether or not the dollar is strong, which is good for imports, or whether or not the dollar is weaker, which is good for exports. And so I don't really like those terms because weaker sounds bad, but if we want to increase our exports, then we need a weaker dollar. So keep that in mind. So you can see that, if we look at percent of exports and percent of imports, our biggest trading partners are Canada and Mexico. For exports, the European Union, China, Japan to a lesser extent. But then we also, have 46% of trade going elsewhere. Imports, China is our biggest importer, but we still import a fair amount from the European Union and also from our neighbors, Canada and Mexico, and then 28% from the rest of the world as well. So when we're doing a multilateral exchange rate, we need to weight all of those exchange rates by how much we export and import to get a multilateral real U.S. exchange rate. So here it is since 1973. And basically, we've had two large appreciations since that time. So it was a depreciation through sort of the late 70s, and then a real appreciation in the early sort of first half of the 80s. Again, a big depreciation until the mid 90s, appreciation, and then another depreciation. So you can see these are pretty significant, and they're going to be important to think about when we think about things like the trade deficit, when we think about our trade balance with countries around the world, and what we might want to do if we want to, say, increase our exports or decrease our imports. So the multilateral exchange rate is definitely the one we want to focus on when we're thinking about total trade.